Well, good afternoon and Happy New Year. My name is Rob Wonderling, and welcome to the 23rd Annual Economic Outlook, brought to you by your Chamber of Commerce for Greater Philadelphia and Firstrust Bank. I must say, the last several months for all of us have been quite a challenge with the global pandemic, social unrest, and related economic aftershocks. But in service to you as your president and CEO of your Greater Philadelphia Chamber of Commerce, and I know I speak on behalf of my colleagues that are also in service to all of you as members of this organization, what has sustained us and inspired us each day is the ability for this business and civic community to rise to the occasion, to solve problems, small and large, that are before each one of us each day, to make a difference, and despite our circumstances, drive our economy forward. And so on behalf of our colleagues, on behalf of our leadership and our board of directors, I really just want to pause and thank all of you, wish you an outstanding, prosperous, and healthy 2021. And we should get started. As I mentioned, this is our 23rd year into living an economic forecast. And for the last several years, it has been through an outstanding partnership with the Federal Reserve Bank and, of course, great chamber member Richard Green and his team at Firstrust Bank. You know, much of our life gets spent around a kitchen table. If you think about all the things throughout our lifetimes that have happened at a kitchen table, from putting together puzzles or airplanes or hobbies, dining with family and friends, or building a business, the kitchen table is a physical and perhaps a metaphorical symbol for gathering together. And I would imagine over the recent holidays, that kitchen table was a place for plenty of family and friend Zoom call, much like what we're participating in today. And I just think it's such an amazing story for the Green family that what they're all about began at a kitchen table. Kitchen tables mean together. They mean a close relationship with friends and family and community. And so, although we're virtual today, let us think about how we're setting a table for economic growth and prosperity. Again, thanks for joining us. We think we have close to 1,000 individuals logging in as I speak. And that's just an amazing tribute to all of your willingness to be active in our work. And so without further ado, allow me to introduce to you the chairman and CEO of Firstrust Bank, Richard Green.
Thank you, Rob, and good afternoon. And welcome to the Chamber of Commerce's 2021 Economic Outlook. It's always an honor to be here at one of the Chamber's most important events, especially this year as we come together virtually amid the pandemic. It's been a very challenging year, but I take some solace in witnessing the perseverance our community has shown over the last several months. With the prospect of the successful and widespread availability and adoption of the vaccine, we can look forward with hope that we will be able to bring about an even more vibrant future for our region. It's in times of crisis, especially, that leadership, or the lack thereof, shows itself to be of critical importance. And regardless of the presence of the vaccine, it is leadership that will make the difference between ultimate success or failure in our national and global recovery. We are most thankful to several outstanding leaders here today and extend our special appreciation for their tireless leadership in and to our community. Dr. Patrick Harker, President of the Philadelphia Federal Reserve; Madeline Bell, CHOP President and Chief Executive Officer; Joe Davis, Vanguard's Global Chief Economist and Head of Investment Strategy Group; and Tim Abell, Firstrust's President. I also want to thank them for sharing their insights today regarding how and when the economy will rebound from the pandemic. In addition, today you will also hear from some local business leaders about how the sustained impact the pandemic has had on their industries and how they are grappling with these unprecedented challenges. One of those who you will hear from is Frank Gamiani, who is the Chief Financial Officer of the Philadelphia Eagles. As Firstrust is the official bank of the Eagles, we are especially pleased to have Frank participate and share his insights today. Firstrust Bank has been honored to be the title sponsor of this event for many years, and it's an important event, one where top business leaders gather together, share insights, and help foster a community of partnership to create a more prosperous and vital region for our companies, our communities, and our employees. While, due to circumstances, the format for this year does not allow for face-to-face connections, there is a silver lining. The silver lining is that the virtual format does allow us to extend our regional insights and perspectives to an even wider audience of business leaders. As a consequence of that, we are welcoming many of you to this event for the very first time. As I conclude, I want to thank all of you for being with us today. And for those of you who aren't familiar with Firstrust, I leave you now with the story of the founding of Firstrust Bank, which was started in the heart of the Great Depression in 1934 by my grandfather, Samuel A. Green, in his mother's South Philadelphia kitchen. Our story is a strong and important Philadelphia story and an American story. And we think you will appreciate how we have continued to fulfill our mission of cultivating prosperity for our customers and communities as Philadelphia's hometown bank. So here is to a very healthy 2021 outlook. Thank you.
Like many classic American and Philadelphia success stories, Firstrust was created out of a great need and a vision to do something about it. During the height of the Great Depression, Samuel A. Green, a Hungarian immigrant, had a fellow immigrant friend who wanted to purchase a home, but was struggling to get a mortgage from any bank. It was very difficult, if not impossible, for ordinary citizens to get home mortgage loans. My grandfather, who was a respected member of his community, he recognized this need. In 1934, in his mother's South Philadelphia kitchen, First Federal Savings and Loan Association of Philadelphia was born. Samuel Green founded the bank on fundamental values of integrity, reliability, and a passion to serve our customers. My father and myself have continued to carry out these same values. Over the years, we've been privileged to be able to help thousands of businesses write their own success stories. Focusing on our customers' needs is not part of what we do, it's what we do. In cultivating our customer success and our community success, we in turn cultivate our own success. We have made and will continue to make investments in people and technology so that people are able to touch their money and manage their financial affairs anytime, anywhere, from any device. We look forward to participating in Philadelphia's prosperity. In this way, we honor my grandfather's legacy. To cultivate prosperity for our customers, our employees, and the communities we serve.
So am I allowed to clap as we have this type of situation going on virtually? We clap and interact, and you can join me, the 1,000 or so of you who are there watching. Good afternoon. My name is Bill Anderson. I'm from Fox 29 here in Philadelphia, but I'm also a lifetime Philadelphian who has had businesses in this city, has worked very closely with many of you, and appreciates all of the work that the people we're going to hear from today, along with the Chamber, have done over the years. We've got a lot to get to, a lot of great minds, so I'm not going to waste a whole lot of time. I just want to remind you that it's okay to clap, it's okay to interact, and it's okay to participate. So you see the chat box at the bottom of your screen. We want you to be able to interact with the great panelists we have, so feel free to put any questions that you have throughout in that chat box. Let's get right to it. We've got two speakers to start us off. First, as Richard mentioned, Joe Davis, the Global Chief Economist and Head of Vanguard Investment Strategy Group. He leads the research and client-facing team that develops asset allocation strategies, conducts research on the capital markets, the global economy, and asset allocation strategies. As I said, we appreciate having him here. And joining Joe in the conversation is Tim Abell, President of Firstrust Bank. Tim's been working with entrepreneurs, many of you, in the Philadelphia area for more than 35 years. He's an energetic and charismatic leader who has significant business experience. I'm hyping you up, Tim. Getting ready to get into this.
I appreciate it, Bill.
We appreciate it. You guys have at it. Let's get that great information going.
All right, thanks, Bill. Appreciate that. Joe, great to be with you again. I know we're here to talk about the economic forecast for 2021, but why don't we start with how you evaluate the economy currently, given all that's happened in 2020?
Well, thanks, Tim, and thanks, Bill, as well, for your comments. And again, hope this finds everyone well. Yeah, again, I think it's not. I think it's important not to underestimate just the profound trauma that we witnessed in 2020. Not only from a health perspective, obviously just the horrific loss of life, and that battle's not over, but also the economic trauma, in part to staunch and to try to quell COVID-19. So in one sense, the fact that we were even talking about a recovery in 2020 is a testament to the swift and bold policy response of fiscal and monetary policymakers. They obviously recognized the trauma that was unfolding. And so that was one of the reasons we saw a recovery, again, from a deep fall in 2020. So now as we sit here, we have a global economy, Tim, that is resilient. There's still parts of the global economy that are clearly still facing duress, particularly tied to social activity. And so as we head into 2021, it's still that battle between how can we distribute vaccine and then just the loss of activity until we get there.
So you mentioned the vaccine, Joe. How long do you think it'll take for the vaccine to have the desired impact and for the governments to be able to reduce some of the restrictions for all of us to travel and go back to the office and do the things that maybe we took for granted a year ago?
Sure, Tim. I mean, it's probably the most important question we all face. And, over the past year, I've read more of medical journals than of economic ones. Sometimes I regret going to the wrong graduate school. But how we think about it and how I think everyone should think about it is how quickly we can close the immunity gap. And what I mean by that is effectively when the population, whether it's the United States or other parts of the world, effectively becomes herd immunity, which means the likelihood of the virus of COVID-19 spread it in an exponential way, those odds fall drastically. And so roughly 70, perhaps slightly higher percentage of the population needs to achieve what we call herd immunity, which is of two components. One is natural immunity, those that have already recovered from exposure to COVID-19. And then, of course, those that are obviously bestowed upon through vaccine application. So how we think about this is, we will close the immunity gap in part because of a very high effective vaccines. That was a clear positive sign, in our mind, a game changer when we started talking about 90% or higher efficacy rates. The second one relates to the distribution of the vaccine. I would say in the United States, we're off to a slow start, but we are assuming and projecting that we will quickly approach 1 million doses a day from a vaccine distribution. Million is an important number because if we continue to hold or perhaps even surpass 1 million, by the late summer, early fall, we will start to quickly approach herd immunity, which means, to your question, Tim, before that, we will see, in a very positive way, a string of events. perhaps as early as April, we will see hopefully a marked fall in the amount of deaths, in large part because the vaccinations will start to reach herd immunity to the most the most vulnerable parts of the population, particularly the elderly. Then we will see a drop in hospitalizations, particularly in the late spring, if a forecast is right. And then finally, as you go towards the fall, the broader population. So I think if when we look at China and we look at the behavior of 1918, what this tells us is, as we get into the middle of the year, say that particularly the third quarter, we will see an acceleration in the economy. Part of that is because the need for lockdown measures will start to dissipate. And secondly, the fear factor, the legitimate fear of dying from this horrible COVID-19, that it'll still be circulating in society, but that fear will drop. And so that will lead to the unlocking of the service sector in a more meaningful way. And that's where we will see an acceleration. And so social activity, restaurants and domestic travel will probably be among the first things that come online in the second half of the year. I think it'll be a little bit longer before we see other things such as, I don't know, business travel and large sporting events. But again, that we need to see data unfold in the coming months.
Well, I sure can't wait. And I think I speak for everybody saying we're anxious for that. Joe, let's shift gears. Next week, there's going to be a change in administration in Washington. And so I'm curious as to what you expect to see over the first half of this year, maybe you can, and how you think the markets will respond.
Well, I mean, I think we will. I mean, we were assuming, we would see roughly $900 billion to $1 trillion in fiscal stimulus or additional assistance at the close of 2020. We saw effectively those numbers. Given the events in Georgia, as well as the continued stress in parts of the labor market, particularly the service sector, Tim, we are assuming roughly 600 to 750 billion in additional fiscal stimulus. I think what we will see is two different approaches to fiscal policy. I think we will see continued focus on unemployment assistance and business assistance, particularly in that service sector. We may see some of those programs continued. I've been advocating the policymakers attaching thresholds to that sort of stimulus. There are parts of the labor market that clearly need additional assistance, but if we could tie that to triggers such as, or thresholds such as unemployment rates, that would give additional assistance, but then would be slowly shut off as economic conditions improve. I think we may start to see that discussed in legislation. The other component, which may take a little bit longer time and maybe beyond the year 2021, will be, I think we will see, and I think there's some positive cases to be made of additional infrastructure spending. You can think of planes, trains, and automobiles, but more than just that. I think we will see some things with respect to green energy. So that's my best assessment, what we'll see from fiscal policy. And it's very likely that anything that's in higher numbers than that, we will see our baseline expectations for growth for the U.S. economy this year are north of 5%. So we've been above the consensus. Fiscal policy arithmetically would even push it beyond that. I think I think some of the risk to the market will be if the market starts to price in even higher expectations for inflation than they currently do.
That was going to be one of my questions today. How are you concerned about inflation, and what do you see as some of the long-term implications from all this monetary stimulus?
Well, right now, I'm more concerned about the market's reaction when we see a modest pickup in inflation rather than inflation per se getting away from us. I mean, I think reflation, and what I mean by that, the markets expect, from the very low levels of inflation that we've had, again, a very traumatic, deep economic recession, we've been in the low 1% range. It is highly likely that we'll get over 2% just arithmetically as we go into April and May. I think our baseline assumption, Tim, this year is that we will have an episode of what we call an inflation scare, because likely that bounce in inflation will come at the very time that the economy is starting to unlock from restrictions and growth is picking up. And so when you put that mosaic together, that's a point where I think market volatility sometimes markets tend to extrapolate. I think ultimately, I think we are hard pressed to see us returning in the United States to a high inflation world. And what I mean by that is expected inflation, trends in inflation, persist at levels of 3% or higher, which was the norm. You go back 20 or 30 years, but we would need to see much higher expected inflation rates. We need to see other things go on in the world and in the U.S. that are beyond another $1 trillion in stimulus, I think, for high inflation to stick. But it is something we continue to research. But again, to the credit to the Federal Reserve and others, they are trying to engineer slightly higher expected inflation. They want your question, Tim, in some regards, I would argue, because inflation expectations had been slipping below 2. And so I think we will see a modest rise in expected inflation, which is consistent with a growing recovery. But you talk about the risk to the markets for a period of time in 2021. It is a higher than expected bout of inflation. And then the market, I think incorrectly, would be pulling forward Fed tightening. That's the risk to the market.
You just mentioned Fed tightening. I can't talk to an economist without asking about interest rates, especially me being a banker. So the Fed's been talking about lower for longer. What do you expect to see in terms of interest rates this year? We've had a slight increase in the treasuries over the last month or so, but what are your expectations as you look at interest rates?
Yeah, and I think it's important, Tim, for everyone to separate the short-term interest rates, such as a 3-month T-bill or the federal funds rate versus long-term interest rates, which obviously try and anticipate the future path of Fed. I think it's highly likely the Federal Reserve, even with a growing economy, will be on hold at least through the year 2022. As we get into 2023, I think that's open for debate, given our growth projections are on the higher side. But nevertheless, I think the long-term interest rates will start to modestly rise, and if it's modest, I think that's healthy. I think that's healthy actually for the broader investment returns. I think it's a reflection of a labor market that starts to gradually repair itself from the trauma it experienced, and I wouldn't be disruptive. If it was something that was a very sharp rise for whatever reason, I think those odds are unlikely. So I think that's a gradual rise. Inflation expectations will rise before real rates, and long-term rates are already rising before short rates. I think, to double the level of, say, the 10-year Treasury where we are today, and that's obviously tied to mortgage rates and everything else, we would need to see a dramatic repricing and change from where the Federal Reserve has telegraphed or articulated where they intend to go. I suppose it's possible, but a lot of things would have to happen before we start talking about a significant further rise in long-term interest rates.
Great answer, pretty thorough. Joe, let's shift gears again and talk about, one of the things we've seen this year is really an acceleration in technology, work automation, digital transformations. It's been one of the, I would call it a silver lining maybe of the pandemic. So what are the key metrics that you're looking at there, and what are the implications from that, you think?
Yeah, Tim, and again, how we've tried to at least think through, and again, history is, certainly not fully written or appreciated from this global shared experience and trauma, but also the resilience of humanity. I think we will witness in the years ahead one of three things. We will see things that have been accelerated, things that are pivots, particularly with respect to policy, and things that I think are actually reversals. Some things will come back. I think social activity is one of them. So there were some, several months ago that believed, we will not see restaurants come back. We won't see air travel. I'm like, I don't think so. I think we will see that. It just may take a little time. In terms of future being accelerated, clearly retail has been one. The move to everything digital was already underway, and history shows in periods of trauma like this, that does get compressed in a nonlinear way. And so I think we're continuing to see that. Where I'm hopeful, and why we are not epidemiologists, we're just reading medicine, but with things that I was strongly encouraged with respect to innovation really tied to the health sector. And I'm really interested in Madeline's comments in a little bit later. But one of the reasons I believe we saw a vaccine developed so quickly is this notion of the idea multiplier we have. So you're asking, what do we track, Tim, in terms of tracking innovation? We look at all ideas circulating around the world, all of them in real time. So there are roughly 2 billion ideas circulating in the world at any point in time that are published in the public domain. And we look at accelerations, and that tends to lead commercial innovation by roughly four years. And we started developing those metrics 2 years ago. And one of the areas that visually popped that said we were going to see a surge in innovation in the coming several years was actually around genetics and biomedicine, just given some of the ideas that are being circulated and cited in the world. The other two areas that were accelerating before COVID-19, that I don't think COVID has changed the trajectory. One field, it has to do with energy technology, particularly with respect to battery technology. And the other one is with food. I don't know exactly what that means, but they're the three areas that particularly were very high. And then again, they may change going forward. But these are areas that I think it wasn't a surprise to me, at least. It was a hope, but also a pleasant surprise that we had 170 vaccines that were candidates within months of China elevating the code, the genetic code, to COVID-19. And I think that's the idea multiplier work. And so, if one wants to be cautiously optimistic going forward on the global economy, I think you do have to point to innovation, which has always been the lifeblood and the underpinning of genuine growth over and above policy.
Wow, that's an amazing answer, Joe, in terms of what you guys are tracking.
Guys,
Hey, Bill, welcome back.
I want to jump in. Thank you. I'm just sitting here listening and taking notes, but we are getting a couple of questions from people. So I wanted to, Tim, actually, the first one that came in was for you. As people are kind of looking for some immediacy and things that we can do right now, and they're expecting the second round of the PPP, Payment Protection Program. Just trying to figure out, can you share what the main differences are with this second round compared to the first, and what impact you expect it to have on the economy?
Okay, great. Well, if you're applying, you can still apply for your first PPP loan. And if you're applying for your first PPP loans, the rules really haven't changed that significantly. They're a little better for some industries, particularly restaurants, food service. If you're applying for your second PPP loan, it's needs-based. So companies need to show that they have had a reduction in their revenue of 25% in any one quarter year over year, comparing 2020 to 2019. Or if it's easier, they can show for all of 2020 versus 19. So it's needs-based. The maximum loan has been reduced from $10 million to $2 million. You cannot have more than 300 employees. But I think it's great that it's really targeted to those companies that really have demonstrated the need based on reduction in the revenues. One of the important things that was also clarified in this program is that the PPP loans will not be taxable. So I think for those that were out there, there was some uncertainty about that, and they did clarify that. And they also made eligible 501c3s and nonprofits, organizations like the Chamber. So Rob or Andrea, if you need a PPP loan, Firstrust is ready. But I think there's a lot of information out there, Bill, and we have some good information on our website. And I think anybody who's interested could go there or any of the other trusted resources and get those details.
Good. Joe, there's another question coming in. This one is for you. You talked about kind of the vaccine and herd immunity and getting up to speed, but they want to know, will the recovery really be based on kind of getting back to business as usual, or does it need to perhaps have more of a focus on businesses responding and doing things differently and adapting more so than just kind of waiting for the herd immunity and getting back up to speed?
Sure, Bill, and I think that's the important point. There's some things where I think the future's been accelerated that we'll continue to see disruption. I mean, we certainly saw that in retail, in e-commerce. That was already occurring, but it's been probably 5 years of change was compressed in months. I think we will. So again. I don't mean to be dismissive of some of the challenges. There will be some businesses and business models that are not coming back, respectfully, I think, but we will see social activity return, but how social activity is conducted will continue to evolve and change, much like it was doing pre-COVID-19. So again, my hope and it's good to hear about the PPP and the needs-based, because again, this is about bridging and buying time until we can get to be, stronger, more broad-based levels of activity. And then there's other things where I think there's pivots. The work from home is clearly one. I mean, you could argue that's an accelerant of a trend underway. But our estimates, based upon remote scores and of every job code, is that roughly 15% of the labor force will likely move permanently. It's not 100%. 15% doesn't sound like a lot. That's the size of the 10 largest cities in the United States. So you will see and continue to see, we're probably only roughly 10 or 20% of the way there, the adjustment of the commercial real estate and the residential real estate markets. And so again, I think that will be a multi-period year. I still think most jobs will move to hybrid. Again, that's an Economist view. It's not a Vanguard, what Vanguard as a business is doing, but I think hybrid is there, that blends social and in-person office. So I still think, we will have offices of the future. And again, we're also, looking to see what others respond to, but that it says that most jobs still need an in-person component, at least for part of the year.
Yeah, we're actually seeing that in the media as well as we continue to evolve and working from home. Another question that came in, the Market and Economies report mentioned that 2020 investors were rewarded for sticking with their investments even through economic shock. So do you have any advice for investors right now that may feel uneasy about what they're reading, what they're hearing, what's the plan going forward for them?
Yeah, thanks, Bill. I would say, for many investors, if we have any, medium or long run goal at all, we have to stay invested. If anything, our expected returns, at least for the next several years, in part because returns have been so strong, they've outpaced the economy. We should expect a little bit lower level of returns, whether it's for fixed income or equity. That said, there's also opportunities. I mean, I think the recovery in the stock market has been so strong. It has not been broad-based. I mean, much of it is concentrated in certain more growthy parts of the market, and it hasn't been as strong outside the U.S. So I think, if investors are a little bit concerned, make sure that they are also looking at all parts of the U.S. market, value companies as well as growth, and companies diversify a little bit outside the U.S. because they have not seen as strong a return. So we could have a modest returns for the broad equity market, but other parts of the market catch up. In the same way that tech and growth has led the way. So I think that's a silver lining in our investment outlook.
Gentlemen, we're going to have to leave it there. Time shoots by very quickly. We could continue this for a long period of time. We're allowed to clap, right? That's everybody.
Thanks, Bill. Thanks, Joe.
Thank you very much. We appreciate you. But we still have more to cover, so stick with us. Again, thank you, Joe. Thank you, Tim. And before we get back into the actual discussion, let's hear from some local business leaders on the lasting impact that the pandemic is having on their industry and how they're responding.
The most lasting effects of the pandemic are likely to be the disruptions and changes to consumer routines. That'll go across all retail. Telecommuting has caused a decline for us in fuel and also in our morning day part, that coffee business. Because of that, we were forced to rethink and build offers for other day parts and as well create new ways to access our brand, delivery, curbside, easier ways through digital to access Wawa without leaving your car or home. In fact, right behind me today, we're opening up our first standalone drive-through concept as a way to accelerate our own plans to give different ways to access. Our industry is built around exactly that, intercepting people on their commutes. So these behavioral changes we knew were coming in the future have really accelerated because the pandemic and forced us to think more digitally and also new ways of access and other day parts.
Given the pandemic, one of the things that will have, I think, a lasting impact for my company, Mosaic Development Partners, is that it really truly forced us to slow down and focus our attention on not just our families, but our business. It gave my partner and I an opportunity to really strategize and plan for a strong future for the company. I will say that one of the things that made our situation very unique, because we work in marginalized neighborhoods, we were able to see firsthand the challenges of the pandemic. We saw how disproportionately people of color and businesses that are owned by Black and brown people have been really wrought and devastated by this pandemic, which really further solidified our company's commitment to supporting Black and brown businesses. So that is a main part that we're going to continue to be focused on. in the upcoming year.
Hello, everyone. My name is Lawrence James. I'm the president and CEO of Connexus Technology. We provide IT staffing and IT managed services. Due to the pandemic, the IT services industry has experienced an increased demand and the need for our products and services. However, the way we get our work done has severely changed. We are not able to come into the office to collaborate, to work on whiteboards together, and just have that intangible connection that we had in the past. I mean, there's Zoom, there's Teams, but something's missing. So here at Connexus, we found a way to help bridge that gap.
In virtual reality, we can connect, we can work on whiteboards, we can see one another, play games. Immersive technology is here to stay.
Good afternoon. I'm Frank Amieni, CFO here at the Philadelphia Eagles. When it comes to live events, we focus on three main areas: safe, clean, and friendly. And having touch points with our fans is utmost importance. But with COVID-19, we had to rethink all our processes. We hopefully are going from a cashless to a contactless payment solution. We're going to go 100% mobile ticketing. We look at our Safety Act certification, our cleaning methods, and everything here at the stadium. But one thing that we can never forget is why you come here. To bond, to share, and to experience. And we're hoping that those Sundays in the fall, we can go from this to this.
It's interesting to see all of that innovation and kind of responding and yet moving forward. And that's kind of what we want to move into the next phase of our discussion. Next up, we have Patrick Harker and Madeline Bell. I'll tell you a little bit about them before we let them take the next round of discussion. Patrick Harker is the president and CEO of the Federal Reserve Bank of Philadelphia, participates on the Federal Open Market Committee, which formulates the nation's monetary policy. He was previously the president locally of the University of Delaware, pretty local, and has published, edited 9 books and more than 100 professional articles. And Madeline Bell, the president and CEO of Children's Hospital of Philadelphia, leading, of course, one of the top-ranked children's hospitals in the United States, nearly 20,000 employees, $3.2 billion a year health system and research institute. Also the chair of the Federal Reserve Bank of Philadelphia's board of directors. So we have a lot of information, a lot of insight. Pat and Madeline, I will pass it on to you, and thank you.
Thanks, Bill. Pat, it's great to see you. You and I are spending a lot of time on a screen these days.
Yes, we are.
So we just heard from Joe Davis. So I'm sure the audience is really anxious to hear from you and your perspective on some of the things that Joe talked about. Let me begin by saying that the Federal Open Market Committee expects the interest rates to stay low until 2022. And what data do you need to see to feel comfortable with rate increases?
Great. And Madeline, it's great to share this virtual stage with you. And I don't have a lot to quibble with Joe on, but I do have to do one thing he doesn't have to do. The standard Fed disclaimer. So the views I expressed today are mine alone and do not necessarily reflect those of anyone else in the Federal Reserve System or on the Federal Open Market Committee. I'm covered. So with respect to rates, if you look at our survey of economic projections, or what the media calls the dot plot, we really are going to keep rates low for long, as Joe mentioned, because what we want to see is real movement in unemployment, that is healing of the labor markets, and inflation getting to our 2% goal and mildly overshooting it. This was a change we made in terms of our monetary policy framework this past year when we issued that framework after really a long period of what we called the Fed Listens program, where we had events here in our district and really around the country to understand what people thought about in terms of monetary policy. So we're willing to overshoot inflation a little bit, not let it run out of control, as Joe said. And by the way, I don't see any signs that that's in the offing, but let it ride a little above 2% and bring the labor markets back to health. I mean, we had a very healthy labor market just before the pandemic hit us. right? We were bringing people off the sideline. We could talk more about that. And this was good. It was good for the companies. It was good for those communities and their families to get work that paid well. And because of that, it was good for the economy overall. That's what we want to get back to. So I don't see us raising rates until we see movement in those two. And those two are our dual mandate.
So Pat, we've already talked a lot about the pandemic and the impact on the economy, and we talk a lot about that together. And we're certainly in a second wave here in the Philadelphia region right now, and businesses are very worried about the fiscal cliff. Our pediatricians are seeing families every day who are talking about concerns about losing their home and where their next meals are going to come from. What can we do to avoid this cliff?
So I think a couple of things. One, in terms of, I can just speak for the Fed, we will keep monetary policy accommodative. That is, we will make sure that the groundwork is there for the economy to heal. First and foremost, though, the most important thing we can do, and I'm speaking to you, a health professional, is get the vaccine in your arm. It won't make any difference to the economy and our society if it sits in a vial. It's got to get into the arm. And that's really what's driving the economy right now, as Joe mentioned earlier. Like realtors say, location, location, location. In this case, it's the virus, the virus, the virus. We've got to get the virus under control. Because as Joe said earlier, even if governments lift the stay-at-home orders and closure of restaurants and so forth, if people don't feel safe, they're not going to take their family there. And so we've got to bring the health back to our community. And in so doing, we'll bring the economy back. That's what I'm looking at. Now, in terms of the fiscal cliff, we had penciled in $1 trillion stimulus. Congress did pass a roughly $900 billion stimulus into our forecast. That's what we were forecasting. Whether there's further stimulus or not, I am in the camp with what Joe said, having it a little more targeted to those who really need it to get them through this period, and those families and small businesses to help them get over this hump, because there will be scarring from this pandemic. There'll be economic scarring. What our goal is to minimize that economic scarring, to let people stay in their homes, to let businesses continue to function. That's the goal. Now, most of that is on the fiscal side of the house. It's not on the monetary policy side of the house.
Well, sort of picking up on what you just said, we're early in 2021 right now, and everybody's trying to figure out what's going to happen for the rest of the year. If you think about what will impact the economy most in 2021, and you just mentioned both of these things, but be interested to hear from you. Do you think it's more important that we get the vaccine in every arm in the population? Or do you think the new relief package or potential relief package under the Biden administration is going to have more of an impact?
Yes and yes. Again, we have to, right? We have to get the virus under control. We've got to get health into our society, into our community, not just here in the U.S., but as Joe said, globally, so we can get the wheels of commerce running again and get people back to work. But that's important. But also, making sure, I think often, and I hear from a lot of bankers in my job, they are banking a landlord who may own 4 properties. Well, they can't not get paid for month after month after month. They're not a large corporation. They don't have deep pockets. They need help. So, and if they don't get paid, then evictions start. So we need to figure out, and that's what I think is on the table for Congress going forward, the new Congress and the new administration, figure out how to make this transition from where we are now to a healthier economy. This won't last forever. God willing, we'll get through this quickly, but we've got to do it right.
So our annual membership survey, one of the number one business obstacles next year is the labor availability due to COVID-19. And with the unemployment rate rising and the transition of misplaced workers, what's the most important thing that we can do for the available jobs in 2021?
Yeah, so there's 2 things going on. One is, and I'll go back to what Joe said earlier, One is just getting people back to work in those jobs that will be the same as they were before. But that's not going to be all the jobs. As Joe said, this pandemic has accelerated trends we already saw. You know, what he mentioned retail. I'll take my old world of higher education. I think higher education is going to be changed pretty substantially. And in many communities, including this community, the Philadelphia community, with over 100 colleges and universities in our region, that's a substantial hit if they don't all make it. Now, they were facing demographic shifts anyway, right? The college age population was in decline across the country. That combined with the United States not necessarily being as strong a first choice for international students to come and study as it once was for a variety of policy reasons and just students wanting to go elsewhere. But the pandemic's also had a double whammy on colleges and universities. It increased their cost and it dramatically decreased their revenue. They didn't get revenue for dorms. And so the dorms are empty, but they still have to pay the debt service on those dorms. So I think those industries will go through changes. What happens to those workers? This is where we at the Philadelphia Fed have been doing substantial work on what we call opportunity occupations, jobs that pay above median wages where you don't necessarily need a four-year college degree. This work, what we know when we looked at 33 metro areas across the United States, and we also can drill down to the Philadelphia region, we know that a substantial increase in salary, $15,000 a year for low-income workers, if they make a transition to a better job. Now, what we just launched, and I really encourage people to come to our website and take a look, is something we call the Occupational Mobility Explorer. We can tell you what are the jobs for people who have a certain set of skills, that the growth rate of those jobs and the salary increase. I'll just give you two examples. So take somebody who's a bill collector. They have skills that could be adapted with some training to being a credit counselor. On average, a 47% increase in salary. That's substantial. Or take a receptionist. They have certain skills that with the right training, they could become a medical secretary with an over 20% increase in salary in making that move. I encourage people to take a look at that because I think that's what's before all of us, for employers, for people who are involved in job training, whether it's community colleges or local government entities, and employees. How do we make that transition? Some of those jobs aren't going to come back. So let's get people into the better jobs.
Thanks for giving those examples. I think when we talk about this conceptually, many times people can't think of real examples. So I think that's really, really helpful, Pat. So Leslie, we just heard Leslie talk about this in the video. She talked about the disparities, and I can speak firsthand as a healthcare provider. This pandemic has put a spotlight on the disparities. Racial minority communities have had a higher positivity rate, a higher hospitalization, and a higher death rate. And it's really sort of put a spotlight on health inequities that we already know exist. So what do you think needs to be done specifically to address economic conditions in low-income communities and in racial minority communities?
So one is definitely get involved with this kind of work that we're doing with and the Cleveland Fed and really across the system in getting people into these better jobs. Again, what we call opportunity occupations, people that can get a better job and they don't necessarily need a four-year college degree, right? They can do this with certificate programs or other programs. There's opportunity there. So first and foremost, let's get people into life-sustaining, family-sustaining jobs. That's critical. Second, for small businesses, particularly what we saw because of the pandemic's exposed a lot of problems we have in our society. They've been there, but they were kind of hidden. And I think now we've seen them. And one of the areas we've seen is for minority-owned businesses, small businesses, micro enterprises, 5, 10 employees, their access to capital or even having a banking account is limited. So part of what the chamber did through its efforts to try to come up with a plan for recovering and more equitably from this pandemic and the subsequent recession is figure out ways to get more of those people into the banking system. It's good for them, it's good for the banking system, and it's good for the economy overall. So there's a series of things we can do, but it's getting people into the economy in a productive way, getting them the support they need to make that transition.
Great. Yep, Bill.
We actually have quite a few questions coming in and not a whole lot of time. So I want to try to get to a couple of them for you, for all the folks who are watching. Madeline, actually, the first one is for you. We were just talking about the pandemic and the impact it's having on the economy. But, with rising expenses and labor costs specifically, how has COVID and the pandemic changed the way that the health systems have had to operate?
Yeah, I mean, I think all of us in hospitals particularly have lost revenue and have seen an increased cost of doing business. So it's been really challenging. But I think there's been really good things that have come up. And we've accelerated telehealth. We were doing 20 telehealth visits a day. And at the height of the pandemic, we were doing 2,000 a day. So really exponential increase. We have learned a lot more about where we source PPE and how we use it. And we are obviously have adjusted for the future. And like other businesses, even though most of our staff are taking care of patients and not working at home, we still have almost a third of our workforce working at home. And that's a big shift for all of us.
Pat, one coming in for you actually is talking about the middle class. Actually, there was an article in Yahoo Finance not that long ago that said that the middle class could face issues and be forced out of many consumer markets as those who already have resources take advantage of lower interest rates. So are there things in place to kind of protect the middle class as middle class tries to grow?
Yeah, so again, most of that would fall. Monetary policy is a very blunt instrument. So what the Fed can do there is, on the monetary policy front, not much, because there's one interest rate for the whole economy that we set, the Fed funds rate. But on our community development work and in our supervision and regulation of banks, making sure that first and foremost consumers are protected, that they have access to capital, right, that they can get the loan they might need to go to college or whatever they need to do. So those things we can do. More broadly, though, I think there's a broader question that you're asking. So the middle class, I think what we've seen over the last, while now, is the middle class feels like it's losing ground, right? And I think that is something that's dangerous to our society as a whole, because the middle class is the middle. It's the bulk of where the population is. And we need to address that. We need to because when people lose hope, and we see this in communities all around the country, right? These islands of despair where bad things happen if people lose hope. This is where we really need to focus on getting good jobs into our economy and getting people trained with the skills they need to fill those jobs. That, I think, provides hope and generational hope for people. That, I think, is an effort that rebuilding the middle class of America, I see as a major effort for all of us, business leaders, community leaders, to really take that on as a challenge.
And Madeline, you guys, we both started a little bit earlier. We talked about the vaccines and the impact that the vaccines are having. But now that they're approved, how do you think that this affects the economic outlook for the healthcare industry in 2021 as kind of the vaccines are rolled out?
Certainly positively. We're all really excited, and we have to remember, there's 2 vaccines that have been approved, but there's 2 more in the queue. And hopefully we'll see a flood of vaccine in the market. I think the one thing I'm worried about is the vaccine hesitancy, and even on our healthcare workers, and in talking to other hospitals, we're only getting about 65% of our healthcare workers accepting the vaccine. Very worrisome. We'll never get to that herd immunity until we get broader population. But the thing to be really hopeful about is that this messenger RNA technology can be applied to both other vaccines and future mutations or future viruses that may come along. And so I think we should really be focusing, and that's a little bit of a longer term outlook, but on the positive that this is really accelerated in healthcare.
I've been paraphrasing a lot of the questions. I'm just going to read this one because this one is pretty specific. All right, Pat. So the Fed's job in normal times is to help the economy operate at an even keel, keep prices stable, jobs plentiful. Its sweeping pandemic response pushed its powers into new territory. So the central bank restored calm to markets, helped keep credit available to consumers and businesses. That's the setup. Do you see this new heightened role of the Fed continuing into 2021?
So I see us continuing what we have in place. I have a basic rule, right? When you're in the middle of a mess, don't change too many things at once. Change the things you have to change, fix the things you have to fix, and leave the rest alone. Number one here is what Madeline just said, get the vaccine into people's arms. I mean, that will help solve a lot of these problems. So I think we're going to continue doing what we're doing. And then as the economy starts to heal, we will start to pull back on some of these things. I need to note, though, the lending facilities that we've put in place are really joint facilities with the Treasury Department. They're not just, and the Board of Governors of the Federal Reserve System. And they were authorized by the CARES Act. So these were not things that the Fed just did on their own, but it was really a remit from Congress to ask us to do these things. As the economy heals, we won't need these anymore. But for now, I think we keep them in place just so we can get through this period of time.
This is why this event is so important, because people are getting their specific questions answered. So I got another one. During the Chamber's, and this is for you, Pat, during the Chamber's annual survey of its members in partnership with your team at the Fed, we found that 62% of businesses say low growth in our region, or they saw low growth in our region this past year. So what's hopeful is that almost 42% of the businesses expect higher growth in 2021. So what are the short-term and long-term steps that we need to take to assure higher growth for our region's businesses, and in turn, a quicker recovery for our entire greater Philadelphia area?
So I'm going to say something that might sound trite, but we need to focus on high growth businesses if we want a high growth economy. I mean, I think it's pretty simple, right? So, I mean, if we want a high growth economy, we need high growth businesses and focus on the things we do uniquely well. Peter Drucker, the management guru, I've always adhered to his mantra, like always play to your strengths. It's management 101, right? It's leadership 101. So the areas that we're pioneering in health and life sciences, I think we just continue to push on. There are other areas that I think we can have a profound effect on with respect to technology, and they have spillover effects, right? They have knock-on effects. So when you grow those businesses, other businesses grow around them. So I think that's the area that I know the Chamber is very focused on through the work they've been doing, the CEO Council and others. And I'm just encouraged by the community coming together right now, say can we focus on to accelerate growth, but also what I really, really appreciate about the work that the Chamber did, and I was honored to be part of that effort, was also make it more equitable. Because if we leave too many behind, the economy simply stalls. I mean, this is something, you cannot grow an economy just at the top. You can do that for a while, but if you leave too many people behind, you can't get the growth that you want. So that's also what we need to do. We can't just focus on the high growth companies. We also need to make sure we're bringing more people into the system, into the economy.
I have to tell you, we have to leave it there, but I have to tell you, I am shocked. And I will share a story with you very quickly. While we were putting all this together behind the scenes, and I was talking to folks, and they showed me the agenda, and I said very candidly, there's no way in the world we're going to get through all of that in an hour. And we did. They assured me that you guys were on it. You could answer the questions. Bill, we've got people who can answer them specifically. We've got the experts in place. And I kind of gave okay, we'll see. And we did. We managed to get through all of that. So I thank you both for that. Some very specific and in-depth questions, and you got the answers. So thank you both. We appreciate it. And that's where we're going to leave it. Wow, that was impressive. And an hour to get through all of that. Amazing insight, outstanding questions from all of you who are participating. I had fun and just got a chance to kind of take notes and learn. And I hope all of you watching did as well. So again, thank you to everybody who participated. Thank you to all of our outstanding speakers and the businesses that shared their insight through video. Of course, thank you to Firstrust for sponsoring the event. Thank you to the Chamber for pulling all of this together and proving me wrong that you can have an enormous amount of information into an hour, well put together and organized. And thank you for including me. I really had a good time. I hope to have the opportunity to work with you again in the future. Thank you, thank you, thank you. Have an amazing day. Rob, am I handing it back to you, or is this my goodbye to all? This is my goodbye. Thank you. And everyone have an amazing day. Happy New Year.